when we talk about book value, usually, okay, we care about for business, okay, because in some area, okay, the financial accounting just meet the text. Even though I always in my class I say, well, we can separate the goal, right? Financial accounting is for financial accounting, and taxation is for taxation. It sounds separate issue, but in some area, those two issues come together. Okay. I know your questions is, how about this truck is for your personal use? It's not for business. While we use automobile every day, right? Here is the issue, okay? For personal use, not for business, for anything for personal use, is not subject to tax benefit. So if there's no tax benefit, that means you cannot create two set bookkeeping, because say for example your personal automobile on your 1040 tax return, you don't see any place to deduct your annual personal automobile expenses. Nowhere, not there, because as per tax law, any personal use item you cannot deduct expense from your income. So don't bother it. So right now, if you decide this is your personal use automobile, even though on the accounting you know you can use accounting to deduct your depreciation, however, doesn't matter how much time you spend on it, you cannot get a tax benefit. So here is the place financial accounting meet taxation. There's no difference. So I hope I answered your questions. If this is your personal use,
no, I mean,
yeah. Let me give you an example. You spend 20,000 on this automobile. Even though you deduct, say, I don't know, $22,000 every year, but you cannot use 2,000 on the tax benefit. So this 2,000 is depreciation, even though you calculate it, but nowhere you can use it. Then, on a certain day, you sold it, 13,000. 13,000. There's no gain, there's no lose. For tax benefit, there's no gain, no lose. You cannot deduct, say, 7,000. No, because you know the cost is not 20,000 anymore, and you don't have gain. Nobody care. Okay, nobody care. So can you give me your scenario? See.
I mean, for a small business.
A small business totally change. Yes. Yeah. For any kind of business, you can have depreciation. So that's very important. Eventually, if we have our taxation again in spring next year, we will talk about this issue. Whenever you have your own business started, you will consider for sure transfer with a convert. Okay, convert your personal use equipment to business, even though it's not brand new, used. You can convert your personal computer, automobile, desk, chairs, copy machine, convert from your personal use to your business use, then you start to take the deduction.
So after 5 years, you depreciate everything?
Yeah, eventually when we go back to our taxation, it's even better. Even better, you don't wait for 5 years. For small business, under, I believe, it's 120,000 expenses, you can write off in 1 year. Right away. This is called taxation 179. Very good tax.
How much?
Under 120,000, I may be wrong, okay, or 105, but it's big amount. Under that total expenses, you can write off in 1 year.
1 year.
It's called section 179 expenses. You don't do the depreciation at all. For small business, you just write off right away. That's very good. All right. Anyway, the last issue for today before we have a midterm, this is one very interesting issue. Okay, so for example, your company purchased the item, installment, no cash payment, installment. So this is one example here. This is one company purchased equipment. The total payment is 200,000. You don't pay nothing. You don't pay anything. You just purchase one equipment to come in, and you have agreement with the supplier. You don't pay it for 2 years. So by the end of 2 years, you pay total 200,000 cash. Right? So this scenario change, right? You don't pay any cash. We don't talk about depreciation right now. We are not talking about depreciation. You purchase one item, equipment, and you receive the equipment, but you don't pay anything. Your agreement is, by the end of the 2 years period, you pay lump sum, assuming your credit is very good. Okay, the supplier trusts you. Okay, give you the machine first. You just go ahead to run the business. You don't pay anything, and on the agreement, for sure you're gonna pay, all right? For 2 years. And the book say, assuming the market rate for the interest is 12%. Assuming it's 12%. So this change our scenario. Even though in the real life it may not happen, okay? But assuming this is the scenario, okay? So it change our example. This is a brand new issue here, because we have a present value here, or future value here. This is the first time in this class we talk about the present value. I believe for those of you who took finance, or you are going to take finance, or you are taking finance, in finance class you talk about present value all the time, every day. Because 200,000 2 years after is not 200,000 today. You pay total 200,000 in 2 years. That really means you pay a portion today plus interest. So on the purchase day, you have 200,000 value equipment come in. However, the principal is not 200. You need to calculate how much for the principal, how much for the interest. So I pause for a few seconds.
Is that
any questions?
the same idea of lease?
Similar, but for the lease, okay, you don't bother lease. If we talk about the pure lease, they really mean you pay this price, but 2 years after, equipment is not yours. That's the pure lease. But this is sales. Sales means by the end you pay the machine belong to you. So still it's different.